Michael Burry, who's played by Christian Bale in The Big Short, recently said I was wrong. In particular, I was wrong to say sell. This was as of March 30th, and he's talking about his prior call on February 1st to say sell. And since then, if you look at how the market has performed, various different indices, it's actually not that great. A lot of folks have seen the recent volatility and thought it's gone straight up, but it actually hasn't. I mean, if you look at the S&P 500, most of that time was spent underwater. Only recently did it start recovering. Now it's around flat, maybe up slightly after today's performance. NASDAQ, that's up 6-7%, so that has done well. But the Russell 2000, that's actually down 7-8%. So just depending on which index you're looking at, it wasn't just a slam dunk call like, oh man, the markets have all just absolutely ripped higher. You haven't seen that across the board. It's been decidedly mixed, I'd say. But of course, online, you show a little bit of humility and everyone starts dunking on you. You have correctly predicted 290 of the last 3 crashes, and even a broken clock is right twice a day. Oh, wait, what? And so people are laughing at maybe him saying, look, I got this wrong. Maybe this is a new bull market. Now, is this a new bull market? I mean, look, the NASDAQ is up. QQQ is up over 20% year to date 2023. What's going on here? Is this just the beginning? Well, it's weird to think so because you have so many different data points that would point against it. You have the Federal Reserve just earlier this month having to announce emergency measures so that banks have the ability to meet the needs of all their depositors. That is not something you typically see where you're like, oh yeah, times are great. In other words, if they didn't do that, if they didn't do this emergency measure, I would suspect you would see things get really hairy really quickly and really ugly from an economic perspective. And so you have emergency measures. Okay, why not cause things to rally? Then you look at the banking sector and you're looking at the number of banks tightening their credit standards. And you're looking at a rapid potential drop in commercial and industrial loans based on tightening standards in the months ahead. So you could potentially see a sizable credit contraction. This obviously spills over to the economy, and we're already starting to see the impact on earnings. FactSet, a financial services provider, they call out how for the first quarter of 2023, the estimated earnings decline for the S&P 500 is negative 6.6%. So the earnings for the S&P 500, this is a key point that folks should understand. I mean, there's only 3 variables that drive your returns. There's, the fundamentals, the earnings, the dividend or the cash flow, and that's not going to jump around a lot. So you're getting like 2% there. And then you get change in valuation. And that's what causes all investors to go nuts. Oh, valuation, that goes up or down 30-50% in a year. That's what causes, the crazy animal spirits. What really drives your return over a decade-long or multi-decade perspective is that first component, the fundamentals. And here it is when you see FactSet calling out like, oh yeah, fundamentals stink. This is going to be the largest earnings decline reported by the index since COVID. That's not good. And you see dozens of the S&P 500 companies, 79 companies issuing negative EPS guidance. This is not a favorable environment where you're talking about what's really driving things. So really, this rally is broadly driven by sentiment expansion, which is really remarkable. You're seeing the sentiment say, well, it's okay. I'm willing to pay more for this, even though the fundamentals are getting worse. That's pretty remarkable. So is this the start of a new bull market? How to invest right now? Well, first of all, in full disclosure, this is not financial advice. So Michael Burry, obviously, he's quick to follow up. He's quick to say, wait a second. Don't take it too far. He goes, going back to the 1920s, there's been no buy the frickin' dip generation like you. Congratulations. And what he's referring to here is a sort of study by Bloomberg of the average return, the S&P 500 average return following down days. And so if you had an approach this year of buying every day at the close that's down, this is actually going to be one of the best performing years for that strategy since going back to like the 1920s, the second best year to do this buying the dip strategy, because the next day it recovers. So then you get out the next day, that sort of strategy. And it does reflect that maybe there's still some animal spirit, some significant speculative behavior going on here. And when I think about the monkey pictures that were being traded for millions of dollars, fairly recently, and the scam coins, I think like there's so much speculative froth that was in the system, partly due to excessive money printing, partly due to excessive stimulus. But I think like usually the tides of human nature is that you go from one extreme to another. And so I suspect, like a pendulum, that we're probably in the middle. And I don't think we've really wrung out, squeezed out all that, animal spirits, all that complete, incredible speculative behavior relative to where we were. And I think in this environment, you're also somewhat paid to wait. I personally keep my cash at Interactive Brokers. And, what they do is they just, invest the cash effectively in short-term treasuries. And so if treasuries yield, 4.6, 4.7%, you're getting most of that back. And that's why, I'm getting, with my cash balances, I'm getting like 4.3% currently. That'll change over time based on where Jerome Powell, does with interest rates. But I look at that and I go, I'm getting paid to wait in a market environment where it's not like valuations are deeply compelling, potential earnings decline, potential further rate hikes, we'll see. You have to have economic measures to sort of shore up the banking sector because of losses that they faced. And by the way, we're going into a likely credit contraction as banks respond to the pressures they face. So that way you have less loans in the future, so that will squeeze the economy likely. And so I personally look at this, I'm very skeptical that this is the start of some new bull market. I think this is just sort of the volatility of the market that throws people off, this sort of noise. Looking at the fundamentals, and I'm not particularly enthused by it. Now, from an investment perspective, how do I personally, does this fundamentally change? The fundamental approach stays the same, which is one, finding those compounders, finding the companies that you think can just deliver that fundamental growth over a long time period. And I called out to my subscribers at unrivaledinvesting.com, and that's where I call out, what I try to find my compelling ideas, a weekly letter, what am I buying and selling, also an exclusive Discord server available for annual subscribers. So on there, just this past week, I called out a company growing over 100% that it strikes me as very obvious that they'll just keep growing in the years ahead. So I'm trying to find these types of things. And I think this is how it might be appropriate for you to consider as well for your own investing is, try to find the businesses that regardless of how the economy is going to perform, there's something obvious about this growth, whether or not it's a product or a solution that should warrant continued compounding in the years ahead. Now, sometimes it's not necessarily one product that's unrivaled. That's ideally one way for a company to grow, or it's disrupting, or it's offering something that no one else has. Sometimes it's just you have an exceptional asset allocator like Warren Buffett, and he's unrivaled, in that thought process. And that's part of the reason why you have something like Berkshire Hathaway do really well over time, which is you go, well, even if there's a recession, even if this isn't the start of a new bull market, I have faith in this capital allocator. So, that is part of the reason why, I've called out Berkshire Hathaway several times. It's a, great company. I've done videos on the valuation. So that's another approach is even if you don't think it's a bull market, find the things that you believe will compound at reasonable rates over time, but you need to qualify it. And this is where a lot of folks got in trouble this market cycle is that they overpaid. And so you need to make sure everything has a grounding, a fundamental grounding in valuation. Can you say, hey, I'm comfortable with this valuation even if there's a recession? And that I think is if you're not really comfortable with the valuation, then it goes back to that cash element where you're getting paid to wait. You can sit and say, hey, I'm not going to swing at this point. I'm not going to swing at that. And there's no called outs here. I can just keep waiting for my fat pitch. And I think that's in this environment where the fundamentals don't scream to me and prices are moving higher. I don't see this as the start of a bull market. Now, could I be right or wrong? Yeah, I could definitely be wrong. But most of my focus is on trying to find those companies where it's like, hey, regardless of what's going on with the market, this business has this clear trajectory for forward growth, whether it's because it's trading below liquidation value or because it has a solution, and it's tapping into a market that's just, 10 times bigger or something like that. And it has a long runway for growth. I hope this video calling out Michael Burry saying, look, I was wrong, has been helpful for you. If so, please make a point of hitting that subscribe button. Thanks so much for watching Unrivaled Investing.